Hi, my name is Brian Kelly. I'm a mortgage consultant. I have been in business since 2001. I wanted to talk to you about a financing strategy for when an appraisal comes in low on how financing could really help keep that transaction together. In a normal situation, let's say somebody buys a $500,000 home and they put 20% down, so that's $100,000 down. Their loan amount is 400,000. Let's assume the home appraises at the purchase price 500,000. Everything goes according to plan. It's a 20% down loan or 80% loan to value. Everything works perfectly as we would all hope. But what if, same situation, somebody's buying a $500,000 home, they want to put 20% down, which is $100,000. They want to borrow 400,000, but now when the appraisal comes in, the appraisal comes in light. It comes in $460,000 in this example. That is a $40,000 shortage, and the normal default is, well, the seller and the buyer have to, come up with an agreement. Either the seller lowers the purchase price or the buyer comes up with the difference. But what if we could keep everything the same? The purchase price stays at 500,000, the borrower's down payment stays at 100,000, the loan amount stays at 400,000. Now the lender can still get the loan done, but if you want to get a $400,000 loan, the lender loans off the lesser of the purchase price or the appraised value. So now if you want a $400,000 loan on a 460 appraised value, the lender no longer views it as you have 20% down. The lender views it as you have 13% down or 87% loan to value. Everything stayed the same so far. Purchase contract stayed the same, down payment stayed the same, loan amount stayed the same, monthly payment stayed the same, but because the borrower has less than 20% equity, the borrower incurs PMI, private mortgage insurance, and you can pay that PMI with a one-time fee at closing called single premium PMI. In this generic example with good credit, that single premium PMI fee is 0.74% times the loan amount. That turns out to be a $2,960 one-time fee. It's a closing cost due at the closing table. And we bridged an appraisal shortage, an appraisal gap of $40,000, kept everything else the same. One-time fee, $2,960 at the closing table. The buyer can pay that. The seller can issue closing cost credits to pay that. The realtors can chip in and pay that. Or if the buyer wants to finance that, that means increase the loan amount $2,960. And today's average rates on a 30-year loan, that would change the monthly payment $12 a month. The single premium PMI is a function of credit scores, equity, and loan amount. In this example, it was non-refundable. There are refundable options. Those are more expensive. This was an example of a non-refundable option. And this was a financing strategy that helped keep a buyer and seller and a transaction together. The only thing that changed after the appraisal came in low was a single premium PMI as a one-time fee at closing paid by buyer, seller, or the realtors. And the buyer wants to finance it, they could do that as well. Just looking at providing creative financing options to help keep buyers and sellers and transactions together. And if you are a buyer or a realtor representing a buyer and you go in aggressive on an offer, just knowing that if the home appraises light, there is this lending strategy that could help lessen the burden on how much additional money the buyer would have to bring to the closing table to make up that difference between purchase price and what the home appraises for. Brian Kelly, 21-year mortgage veteran. If you have any further questions about this, if you wish to get pre-approved, if you want to look at refinancing options, I would love to have a no obligation, no cost consultation. I'm available. Give me a call anytime. Appreciate your time. Please like this. Please subscribe. I want you to be aware of new videos coming out as I make them available. Thank you again so much for your time.